if you look at income tax, the top 1% of taxpayers earn something like 14% of income and pay something like just under 30% of tax. So that's a measure of how progressive the system is. Worth saying that if we looked at all adults rather than just taxpayers, then of all adults, the top 1% pay about a third of income tax. Hello and welcome to the IFS Zooms In. I'm Helen Miller, Director of the Institute for Fiscal Studies. And today we have a treat for you because we are talking about tax. In fact, because tax is so interesting and so important, we're not just talking about tax today, we are bringing you a new mini-series on how to fix the structure of the tax system. This isn't about whether Rachel Reeves should raise more money in the upcoming budget or how she might do that. We'll bring you an episode on that next month. It also isn't about how much tax revenue the government should raise overall or whether it should raise more or less from rich people. These are both political choices and not things that we take views on here at the IFS. Instead, what we are talking about is the kinds of taxes the government uses, how they are designed, and how they are doing more damage than is necessary. So whether you are someone who wants tax revenues to go up, down, or sideways, whether you want them to be more or less progressive, I think there's lots of room to agree that our tax system is a mess and that a better designed tax system would be better for us all. We are going to look at tax schedules with bizarre kinks in them, at tax structures that manage to simultaneously both incentivise some things that we don't want while disincentivising some things that we do. We'll look at tax breaks that might look great in principle but are actually dreadfully targeted. We're going to start today with looking at income taxes, but in future episodes we'll also look at other taxes, including on wealth and spending. And most importantly, across this series, we're not going to just moan about the tax system, although there'll be plenty of that. We also want to talk about how we can fix it. We're not going to wallow in how much tax revenue is raised overall, but here's a fun fact for you. In the 1960s, the UK was a relatively high tax country. Over subsequent decades, that changed, as many other countries, many other European countries in particular, increased their tax take substantially. Just 5 years ago, UK tax revenue as a share of national income was below the OECD average. Since then, our taxes have increased substantially and are now due to reach a historic high in the UK of around 38% of national income. That now takes us above the OECD average and closer to our European neighbours. And whether you love or hate that trend, it means that the government will be raising over £1 trillion in tax each year. And how we do that really matters. Doing it more effectively would allow us to raise the same revenue but at lower costs. So to unpack all this across this new mini-series, I'm joined by my two colleagues here at IFS, Stuart Adam and Ben Zaranko. Stuart is what I like to think of as our in-house encyclopedia of tax design. If there is a person who knows more about the design of the UK tax system, I certainly haven't met them. He was also an editor of the IFS Merley's Review, which was a huge comprehensive study of the UK tax system. It was published in 2 big books that we have with us today. Stuart and others here have also written hundreds of other reports on how to fix taxes. There is plenty of material for us to be drawing on. And then Ben's role today is to ensure that Stuart and I don't get too stuck in the weeds, which is perfectly possible to happen. Ben, like many others at IFS, have had the wonderful experience of wandering over to Stuart's desk with a relatively straightforward question on tax, only to leave an hour or more later with a whole list of answers to questions they didn't even know they had. So today we're going to try to create that experience for all of you listening. Let's get going. Before we get stuck into the details of income taxes and how we fix them, I think we have to start with what we are talking about when we talk about tax design. Because I said at the top, we're not thinking about how much revenue the government raises, and we're not thinking about how it raises it from different people. They are both kind of the key objectives of the tax system. We're thinking about something different, which is for a given level of revenue and a given level of distributional considerations, how you design it.
Yeah, and that was the challenge we set ourselves in the Merley's Review, not should we be raising more or less, should we be redistributing more or less, but how can we do that essentially at the lowest possible cost to taxpayers? Because obviously, none of us likes having to pay tax. It is a burden on people, though we get lots in return for the taxes we pay. But there is a cost to raising taxes over and above the actual amount of cash that's handed over. And that's because taxation incentivises people to change their behaviour. And so if people change their behaviour to reduce the tax they pay, that means that they're not doing what they want to do. They're changing their behaviour, and the government doesn't get as much revenue as it would if the people didn't change their behaviour. And so there's a question as to how do we minimise the cost to taxpayers for the amount of revenue the government gets in. Now, if we start from the presumption that other things equal, basically people know what they want to do and they do what's best for themselves, and markets all work perfectly to get people interacting with each other, then broadly speaking, what we would want to do is minimise the extent to which tax changes people's behaviour. And now that's not always going to be the case, because people don't always do what's best for themselves or best for society as a whole. And so there can also be a role for taxation in correcting market failures, certainly, more controversially, correcting people's own mistakes if the government thinks essentially it knows better what's good for people than they know themselves, or at least that they're going to act on.
So just on that, before we start with other things government are doing, how are we doing so far, Ben? So what Stuart's basically just described is economic efficiency, which is what we spend our days thinking about in the tax team world. Does that make sense?
Yeah, but this is going to be the first of many similar interjections. Can you give an example of what you mean of someone changing their behaviour in a way that means they've suffered some cost and society is worse off because of a tax? We make it like a specific, tangible example.
The simplest, most obvious example, and the one that in a way is most fundamental to the tax system, is disincentives to work. So if you tax people on what they earn, then it means that they get less for doing the work than it costs their employer to hire them. And that means that people are likely to do less work than if the tax weren't there. And there is something that in the absence of taxation would be profitable for the employer and worthwhile for the employee. That doesn't happen.
Right. So I have a house with a big garden, and I want to pay you, Stuart. I'd be willing to pay you £100 to mow my lawn for every week for summer or whatever. And you'd be willing to do it for £100. But if the taxman takes £30 of that, you only get to keep 70, and for £70 you decide it's not worth your while, so we don't do that transaction. The lawn doesn't get mown, everybody's a bit worse off, and the taxman hasn't got his £30. That's the gist, right?
Exactly.
Yeah, and it's worth pointing, because I've done talks like this many times, and people say to me, "Well, I don't change my behaviour because of tax." Obviously, not everybody does, but the point is we have pretty good evidence that, take the whole economy, take the how many people we've got nowadays, 70 million people in the economy. Across all of those, people are changing their behaviours about when to start work, how many hours to work, whether to take a promotion, whether to work part-time, when to retire, and so on and so on. So actually, even if these effects are relatively small at an individual level, and sometimes they're not small, but even when they're small at an individual level, actually add them up across the economy and they can be really big, chunky effects. So before we talk about income tax and give people some examples of that concretely, so we've said that ultimately governments are trying to raise revenue and redistribute incomes according to political preferences. But we think they should be doing that in a way that's as efficient as possible, given those aims. But we also think it's a good idea for the governments to be trying to reduce compliance costs, administrative costs, so they're not, being more burdensome, to be transparent so that people know what it is that they're paying, and to be horizontally equitable, so that if
I need a little bell to ring every time you say something like that.
Yeah.
Go on.
About horizontal equity.
Yeah.
So that's just the idea that you take two people. So say that, you and I, Ben, are really similar, and, we're both economists, we get paid the same, we have, similar things. But if the tax system treats us very differently, not for any good reason, just because, then that's horizontally inequitable. It's unfair that you and I would get treated very differently, even though we're very similar.
Can we have some concrete examples of, two people look very similar being taxed differently? It sounds a bit abstract. Let's try and, paint a picture for our listeners.
So it can arise in all sorts of contexts. One is two people doing essentially the same work, but in a slightly different legal form. So one being an employee and another being self-employed, for example, which means that they get taxed differently.
I remember stories last Christmas about, I won't name the high street retailer in case they ever want to sponsor the podcast, but bringing in people for the Christmas period as self-employed contractors. So you might have two people on the tills. One is an employee paying a certain amount of tax, and the person next to them is a contractor paying less tax, more tax privileged legal form. that feels a bit bizarre to me.
Yeah, exactly. I think that's a good example. And of course, sometimes people who are self-employed are doing something genuinely different and maybe entrepreneurial, running a business, putting their capital at risk or whatever. We'll come back to that in future episodes. But actually, very often people are just doing very similar things in different legal forms. There are other examples all over the tax system. I mean, people who happen to prefer cakes rather than biscuits and end up paying different amounts of tax, or people who use gas cookers versus electric cookers. All of things like this that you'd think of as just potentially inconsequential differences in tastes or characteristics or the particular form that activities happen in, they would say ideally these things should not matter for the tax you pay.
So we've got these things that the government's should be trying to do. We've got economic efficiency, transparency, low compliance, administrative costs. One more concept we should throw in there, because it's going to come up again and again, is as a rule of thumb, and this is not a hard and fast every time you should do this, but as a rule of thumb, you want the tax system to be neutral unless there's a very good reason to deviate from that. And neutral basically means when you take two similar people or two similar activities, you should tax them in similar ways. The non-neutrality is when you take something that's very similar. So you take a cake and a biscuit or something in the VAT system, you give them very different tax treatments. And there was kind of two reasons for that. One is this fairness reason. Usually when you have non-neutralities, you have exactly this problem that you take two similar people, tax them differently. That is horizontally inequitable. It's also exactly where you have these behavioural changes. So if you have some activity that's tax privileged or tax advantaged, people try to do more of that rather than something else. So this concept of trying to be neutral won't always be the best way to do a tax system. I should say, for all the economists out there, there are lots of economists, including some in this building, that are working on optimal tax models and how to make tax design, fine-tune tax design. And sometimes you want to deviate from neutrality. So, for example, we tax pollution in order to try to, we are targeting that and trying to get less of it. But in general, the problems we have, a lot of them come down to the fact that we're nowhere close to neutral, and moving towards neutrality would be a good thing.
And I'd add a third advantage of neutrality, as well as tending to be more economically efficient and tending to be fairer in the sense we've discussed and more horizontally equitable. It also tends to be simpler. But in what I think of as the two senses of simplicity, one simpler for people to understand, more transparent, but also operationally simpler, easier for the government to administer, easier for taxpayers to comply with their obligations.
Great. So there's our toolkit. So the governments are trying to raise revenue and redistribute incomes. And we're saying that for whatever choices you make there, how much revenue you want, how much you want to redistribute incomes, we're saying let's design a system that is, doing not too much damage to economic efficiency, that is, not having too high costs, that is transparent. We're basically looking for this rule of thumb of neutrality. So that's what we're going to be. A well-designed tax system is one that achieves those political aims with the lowest costs possible. So with that kind of sketched out, should we look at an actual tax? And why don't we start with income tax and national insurance contributions? They are the two biggest taxes in the UK. I know, Ben, you're keen to do some kind of quick fire round on what is this tax before we get into the weeds. So
for us at this point, once we get into the details, given that I know the least, it feels odd for me to be in the receiving end of questions. So why don't we start with what are income tax and national insurance?
They are taxes on income.
All income?
No. So income tax is a tax on kind of income broadly defined. So you can think of it as a tax on the money you get from your employment, from your job, but it's also a tax on things like income from being a landlord or having dividends. National insurance contributions are importantly different because they're really just a tax on earnings, so on money you get through your job. It doesn't get applied to things like dividends and landlord income.
Okay, so let's start with the rates at which these taxes are levied. Can you talk me through that? And I guess we're probably going to end up having to talk through thresholds at the same time.
Yeah.
So basically, how does income tax work to begin with?
So I'm going to paint a picture for you of a tax schedule. Actually, we'll post a picture for those who want to watch along on the video. You can earn or get in income about £12,500 before you start paying any tax. That's your personal allowance. After that point, you will start paying income tax at 20% and you'll start paying national insurance contributions at 8% if you're an employee.
Only on the bit over 12,500.
Only
right?
on the bit over 12,500. So you'll have a combined rate of 28%. I should also note in passing here that that's just the rate of national insurance that's applied to employees. That is ignoring the really important bit of employer national insurance contributions. That's another 15%. That you can't just add on, but it's another 15% on jobs, and we're going to come back to that bit of the tax, but let's not forget it's there and it's important. But sticking with the bit that's directly on personal incomes, so you have your personal allowance, then you get a rate of 28%. Then once you earn over about £50,000, you get income tax at a rate of 40% and national insurance contributions at a rate of 2%. So income tax has gone up, national insurance contributions have gone down. That's a combined rate of 42%. Move further up the income distribution, then at £125,000, the additional rate of income tax kicks in. So you have a 45% rate of income tax, 2% of NICs, that's 47%. What I've glossed over there, if you could see the chart in front of you, was this very bizarre hump that starts at £100,000. So there is another, basically effectively a rate of 60% income tax. A secret rate of 6% income tax, which becomes 62 after national insurance. That is this weird hump between 100 and 125. I should also say that what I've just described to you is the rate schedule in England. It is a bit different in Scotland, and they have a few other rates and some higher rates.
And it's the same. The Welsh system and now Northern Irish system have the English system as well. Though the Welsh have the ability to
change,
but they haven't chosen to use that. Okay, so
that's right.
We'll park the evolution thing for a minute. Okay, thresholds. So they really matter, right? We tend to get bogged down on the 20%, 40%, whatever. But actually, the point at which you start paying 20% or 40% or 45% really matters too. So those haven't been increasing much of late.
No, so the default is that those things would move up in line with inflation. They haven't been doing that. They've been frozen. And because they've been frozen in recent years, we are getting more people paying tax and more people paying higher rates of tax. We have fiscal drag in full force.
Fiscal drag is there's lots of columnists in papers like The Telegraph who love talking about fiscal drag. But this is basically people doing jobs that might have in the past life, you maybe have only attracted the basic rate of income tax and now paying the higher rate on some portion of their income. That's basically the idea.
Yeah. I think I'm right in saying, Stuart, there's about a third of people who don't pay income tax, haven't got incomes high enough to pay income tax. Stuart's nodding along at me.
Yeah.
But that share of people who are paying income tax has changed over time. And it changed for a while as governments kind of explicitly changed the threshold and took people out of income tax. But now, because the personal allowance is frozen, people are being dragged back into paying income tax.
If you not pay income tax, it means your income is less than about £12,500 per year.
Yep.
Right. We sometimes chuck around the words progressive and assume people know what we mean. Before I ask my next question, do you want to explain what we mean by progressivity or progressive?
Yeah, so an income tax is progressive if the percentage of your income that you pay in tax rises as your income rises, so that higher income people pay a higher percentage of their income in tax than lower income people do.
So it's not just that they're paying more in pounds and pence, they're paying more as a percentage of their overall income. That's the point, right?
Exactly.
So how progressive is income tax and national insurance?
To give you a sense of that, so income tax is more progressive than national insurance because of this feature we just described where
it drops to 2%.
It drops to 2%. So the income tax rates, marginal rates go up, but the national insurance contribution rates go down. It's still progressive for most people, but at the very tippy top, that stops being true. But to give you a sense of scale, if you look at income tax, the top 1% of taxpayers earn something like 14% of income and pay something like just under 30% of tax. So that's a measure of how progressive the system is. Worth saying that if we looked at all adults rather than just taxpayers, then because we just talked about not everyone's paying income tax, then of all adults, the top 1% pay about a third of income tax.
It's quite a big tax in terms of all overall revenues, and we're quite reliant on a relatively small number of people for a big chunk of that.
Yep. So overall, income tax and national insurance combined raise something like a half of total revenues. They are the two big sort of workhorse taxes of the system, and yeah, they are paid disproportionately by the top.
Okay.
And actually, it's a long-running trend. So for many decades, we saw more income tax being paid by the top. And for a long time, that was because of rising income inequality. So the top had more income and they paid more tax. Since the financial crisis, so since around 2010, actually top incomes haven't risen, but policy choice has meant that we are choosing to raise more tax from the top. So we have chosen to become more reliant on our tax revenues from the very top of the income distribution.
Okay, that's the end of my quickfire questions. One slightly less quickfire question. Do we like income tax? Is it a good tax? Is it a bad tax? I know you guys love to moan about the design of the system. How does income tax stack up?
Well, I think good in the sense, it's surprising if you saw a tax system without an income tax. Right? Income is, I think, a sort of a natural thing to want to tax, and therefore unsurprising that we have one at all. They certainly could be better in the way they're designed, but they're not the worst design bits of the system. I say part of the oddity comes from the particular design of the tax schedules are more complicated than they need to be, and part of the problems come from this fact that we have a national insurance contributions that's like a second income tax but not quite, and that creates all sorts of problems, including complexity and lack of transparency.
So earlier on, Helen, you touched on that bit of the income tax schedule, so between 100,000 and 125,000, where you get hit by a particularly high marginal tax rate. Maybe we could talk a bit about whether that's a big problem or why it's a big problem and some of the issues it creates.
So I think there are a couple of different questions there. One is how many people and who is affected by this, and then another is how problematic is it. In terms of how many people are affected, it is still a small minority. We're talking about something like 3% of adults in any given year, although of course more people will be affected at some point during their life. But that's still a pretty small fraction, although it's a fraction that has been rising quite rapidly over the years, not least because that £100,000 threshold has been frozen at that level since it was introduced 15 years ago or so. There is an obvious question as to why you would want the rate to go from 40 up to 60 and then back down to 45. That is pretty weird. I think my bigger objection actually would be to how it's described, because the fact that this is described as a gradual withdrawal of the personal allowance means that basically almost nobody understands it. Nobody understands that what this effectively amounts to is a 60% income tax band. And I think there's no obvious reason to do it or describe it as withdrawal of the personal allowance, except to make it deliberately obscure what this is doing. So I think if you really want to have a 60% income tax band, let's call it a 60% income tax band and let's have a public debate as to whether rates that go from 40 to 60 to 45 is really what we want the tax schedule to look like. But having it where you say that we have a higher rate of 40% and an additional rate of 45%, and then people above 100,000 have their personal allowance gradually withdrawn at a rate of 50p for every extra pound of income, is just making the tax policy deliberately obscure.
Not only is there this 100k threshold within income tax, the government has also decided to make the £100,000 the point at which people lose access to childcare subsidies. So for the minority of people who are in this situation, some of them will not only face a higher marginal tax rate, but actually face the withdrawal of pretty substantial subsidies for childcare. So it can mean that you can have people in a situation where you're earning £99,900 pounds and you get a pay rise. You'd need a pay rise of something like £35,000 to be as well off as you just were, because you lose so much subsidy. That is completely ridiculous, right? The idea that you'll have people turning down pay rises or increases in work or shoving extra money in their pensions in order to get around this situation, even if it's a small number of people, it's a ridiculous situation to be in.
Yeah, and for those people who are affected, that is a much, much worse problem, a much bigger problem with the system than the withdrawal of the personal allowance, because we're not here just talking about a rise in the proportion of each individual pound that gets taken in tax as you cross £100,000, but a big jump in the actual tax bill. So your income actually takes a dive if you get a pay rise from £99,000 to £101,000, as Helen said, you can easily be worse off on £130,000, even £140,000 in some cases than you would have been on £99,000. That is not a sensible feature of the system.
And I guess if you're a group like doctors are probably the most obvious example, where they might have very inflexible pension schemes. It's harder for them to sort of shift money into their pension to reduce their taxable income. And I also wonder, are we storing up a generation of, so we shouldn't get too bogged down on this, but they're a group of like high earners. You got to be a high earner to be tipping into this zone. But if they're all just absolutely shoveling huge amounts of cash into their pensions, are we just storing up a generation of early retirees who are going to drop out the labour force at 58 or whatever it is and not
possibly.
be able,
I suspect they're not
working.
shoving in so much that will have such a material impact, with my guess. I mean, one thing I worry a bit more about, this is more anecdotal, but there'll also be a lot of women who are affected by this, who might, again, it's everything here we're talking about is a minority, but women who are coming back from work after having children, who might already, face a decision about whether to go full-time or part-time and how much to work. And then you suddenly face them with a 6% marginal tax rate and the potential of losing tens of thousands of pounds. To the extent that in and of itself makes women stay more out of the labour market than they want to be, that can have long run consequences as well if they don't get back into work as quickly as they would otherwise have wanted to.
Small group, but a very big deal for those affected. Is that basically the summary?
Yeah. It was more importantly, because I said we won't just moan about the tax system here, but to make fixes. I think it's also the case that it just doesn't need to be like this. However you want to tax rich people, you could just do it more simply and more transparently without having this horrible camel's hump in it. So it's also just that it's the case that it's not like a feature we have to achieve what we want to achieve. We could just do it in a simpler way.
I should also add that while the particular examples we've been talking about are for those at the very high income end of the spectrum, these kinds of problems are not confined there. So if you want an example from the lower end of the income distribution, people on carers allowance who are receiving benefits because they are caring for someone at home. So typically, might be an elderly spouse or parent who needs care. Now you can do some work and earn some money on the side while keeping your carers allowance, but there reaches a point at pretty low level of income where earning an extra pound means you lose that completely. And again, you get this cliff edge problem where actually you're worse off earning a bit more than you are earning a bit less, which feels like, again, in principle, an undesirable feature of the system. Also, the hump in the marginal rate of income tax that you get at 100,000, there's a similar feature somewhat lower down where child benefit gets withdrawn above income level now starting at £60,000, if I remember rightly, where again the marginal rate rises and then falls back again. Now again, that's still a better off group in society, but we're getting further away from it being the very top.
Isn't there another thing here about, with the carers allowance example and the child benefit example, of the complexity there, and it puts a lot of onus on people, right? Because I've read stories about someone has accidentally earned a little bit too much on carers allowance, hasn't told the DWP because they didn't realise they had to. Few months, years down the line, DWP's ringing up saying you owe us however many hundreds or thousands of pounds, for which people just weren't prepared for and had no idea, because the system's so complex and there's arbitrary cliff edge in it and people are getting really shafted there. And similarly, do you have to, because the child benefits thing is the individual versus households problem and things like that, and you have to self-declare it and fill in forms, and we're just putting extra.
No, it's horribly complex. The child benefit one's horribly complex because you can have it. You can collect it in one half of the household and have it taxed back in the other half of the household, or you can choose not to claim it, or you can choose to kind of claim it to get your national insurance credits but not actually claim the money. And navigating that system is really hard for people to know, and it matters what they do. So it's really complicated.
In the government's defence, to some extent, these things are complicated, but in some cases they're done like this because some of the alternatives might be even more complicated. So if you take something like carers allowance, would it really be simpler? I can see it would be better in other respects, but would it really be simpler if we were to introduce a proper means test to say that as your income increased, your benefit would be withdrawn a little bit for each extra bit of earnings? I could see that becoming more complicated, particularly if, again, some of these people might be working part-time, doing more and fewer shifts at different times. Their incomes are messing about. Sometimes, actually, we have these cliff edges precisely because they are simpler than the alternatives. And that's been a problem with, for example, the issue of withdrawing child benefit, that actually doing it on family income, given that at the moment HMRC, the government, doesn't collect information on everyone's family income, is not necessarily going to be simpler, even if it might be better in other respects. So I think some of the things we were talking about are things you can say, actually, there are straightforward improvements available here. Some cases we're talking about a system that is problematic, but it's not straightforward to see that there's a much simpler, easier way of doing it.
Although, to play back to Stuart, what I know Stuart said to other people on the child benefit one, I mean, we used to have a universal system. You can make a case for that. We have a means-tested part of the system to do with children within universal credit. You can make a case of that. The withdrawal of child benefit is this new weird hybrid that's kind of being withdrawn and means tested in a particularly funny way. So I think I'd argue that there are, even conditional wanted to have a means tested child benefit, there are better ways. It's hard to argue this is the best way to do it. So yes, some complexity is necessary. It's not clear we need this kind of complexity.
No, absolutely. I mean, if you want to withdraw child benefits specifically from high-income families, it is a hard thing to do well. I completely agree with you on is what we have at the moment is, in effect, two different means-tested child benefits, one within universal credit and one that's called child benefit. And they're both means-tested, but they're means-tested in different ways at different income levels. And that seems crazy to me. You should have a universal child benefit that's as high or low as you want, and a means-tested child element of universal credit that's as high or low as you want, and decide what you want the balance of those to be. But it's hard to see a good case for having the two different means-tested systems as we've got at the moment.
I know I started this, but I'm dragging us back out the weeds.
Let's get out of the weeds.
We've gone too far. So the one thing I'm taking from that is you should think about the system as a whole, right? You can't just think about individual taxes or benefits when they're interacting with each other in horrible ways. And we shouldn't try to... I think Keir Starmer said this, like, we should tread lightly on people's lives or something. Try not to like put too much burden on people who are not very well equipped to handle it.
And the takeaway on the schedule is that some of the complexity is necessary, a lot of it's not. We could have a simpler tax schedule. But staying out of the weeds from it, should we go back to talking about national insurance? We've just been zooming in on income tax and zooming in other bits of things that relate to that. Let's go back to this idea that we have actually the second tax on earnings and the kind of issues that creates. And I guess I first want to put to bed some of the myths about national insurance, because there are lots of myths. And I think every conversation about NICs gets kind of held up because everyone thinks it's something it's not. So I think the first thing is that it's not really a contribution in the sense that, or at least in the sense that there's a very, very, very weak link between the amount of money you pay in through NICs and the amount you get back in any kind of benefits. I mean, people always point to pensions, and it is true that you need to make 35 years of contributions to get your full state pension. But if you make lots and lots and lots of contributions, you don't get a higher state pension, you get a flat state pension. And there are lots of ways to get credited with national insurance contributions that don't include earning any money. So, for example, looking after children. So there really is a teeny tiny link between the amount you put in and what you get out. It's really just a second tax. The other thing to say is it's not hypothecated to the NHS. There is no sense in which this is special money. It just goes into the Treasury coffers and comes out whenever they want it. And perhaps the third thing to say that Stuart and I have talked about a lot is in relation to the self-employed, because we haven't mentioned this so far, but the self-employed have lower rates of national insurance contributions. And importantly, actually, there is something called employer national insurance contributions, which is put onto employment jobs, but not onto other things, including self-employment. And there's really no good justification for that. The self-employed have access to almost identical benefits to employees. So we're not in a situation where we should be thinking that they pay less and get less out. They pay less and get the same out is the way to think about it. So that's my little rant about national insurance before we get into anything else.
Yeah, so if I can add two caveats to that. One, just before people start complaining, when you say that national insurance just goes into the general government pot, there is a formal mechanism where a bit of it gets top sliced and goes into the NHS, and there is a national insurance fund that national insurance contributions get paid into and certain so-called contributory benefits come out from. Those things do exist. They are essentially
Illusions.
accounting fictions. They exist on paper. They have bear no relation and have no impact on how much is actually spent on the NHS, what benefit entitlements people have, and so on. So it is there as an accounting fiction. It doesn't have any real world implications or consequences. The other thing I should say is that you mentioned employer national insurance as, and almost by the way, there is this other thing. But actually, employer national insurance is now about 3/4 of all national insurance revenue. It used to be more like an even split between contributions by the individual and contributions by employers. But over time, and particularly actually in the last few years, we had Jeremy Hunt reducing employee and self-employed national insurance contributions, and then we've had Rachel Reeves increasing employer national insurance contributions. National insurance nowadays should mostly be thought of as a tax paid in the first instance by employers on the salaries they pay out, rather than thinking of it as the amount that individuals are paying on their earnings.
It's interesting that though, isn't it? Because it feels like there's two reasons, two related things going on here. So one is that people maybe don't mind paying national insurance so much because they think it's linked to something they like, falsely, like the state pension, like the NHS. I think that comes out in polling often when you ask people what taxes they would be happy to pay. The answer is none of them, but if you make me, maybe national insurance over income tax. And then the second thing is the fact that most of it now comes from employer national insurance. I think this is related to why it was increased in the budget last year. Is it doesn't feel like you can't see it in your paycheck, right? It's not something that's like visible that you're paying, even if eventually you end up paying in the form of lower pay rises or lower other benefits or whatever else, the other ways that businesses try to recoup the costs. But it's like almost two levels of, I'm trying to think of what the right word is, but it's almost like a veil that sort of stops people. It makes it more complicated for people to really see who's paying and why.
But just on the first of those, I think imagine we did have a contributory social security system. And actually, lots of Europe have this, right? In lots of parts of Europe, they have higher social security contributions, and there is a much bigger link between what you pay in and what you get out. For those kinds of taxes, you would expect people to feel and behave differently for those taxes, because it's a tax, but you're getting something in return. So it would have different effects on labour supply and work incentives, for example. So I think the fact that people who believe that it's contributory behave differently is not a surprise at all. What we're pointing out is that you shouldn't believe it's different because you're not getting anything in return. But if it was, and actually look, you could imagine the UK going towards a system that was more European in that sense, right? We could have a system where actually the more you paid into national insurance, the more you get out for your pension. We could have welfare benefits like unemployment insurance that was more linked to what you'd paid in. We could have that. We don't. And we've moved in the other direction in the UK, if anything. But those taxes do exist out there. It's just that it just happens to be it's not the one that we have here in the UK. And on that point about employer NICs being behind some kind of veil, I think you're right. I think people think of it as a tax on employers, and to some extent, some of it might be borne by employers, especially in some contexts. But by and large, you'd think that it's going to be shown up in wages.
Or people think a lot of the recent
or
increase
prices
might have gone into prices, right?
Yeah.
Okay. Can I ask then it sounds like a simple question, but undoubtedly never will be. Why do we have two? Why don't we just merge them? Could you not? Would that be a simple exercise?
This is Stuart's favourite topic. One of his favourite topics. Go on, Stuart. Why should we merge income tax and national insurance?
I think there is a very good case for merging income tax and at least individual national insurance, employee and self-employed national insurance. I think first and foremost, just for reasons of transparency, that the tax you pay on your earnings is the combination of these two things. But you never hear anyone talking about the 28% basic rate or the 42% higher rate. They think of income tax and they don't think it's the combined effects that matter. And that'll be simpler to see if you had one combined tax. It would also be operationally simpler. There are differences between them. Income tax is annual, and national insurance is assessed more or less separately for each pay period. But there are also other differences in terms of what kinds of income are subject to income tax versus national insurance, and for that matter, what kinds of expenses are deductible and the way pension contributions are treated and various other things. Now, for me, that actually, if anything, is all the more reason to integrate them, to merge them. It just seems mad that we have one tax on earnings that's annual and one tax that's done separately for each pay period. We should decide which is better, which we want to do, and do that. To the extent that we've got something like savings or investment income that's subject to income tax but not national insurance, merging them would force you to say, do we want this form of income to be subject to tax, or don't we? Or do we in fact want what we in effect, in practice, have at the moment, which is it's subject to an intermediate rate of tax that's equal to the income tax rate rather than the income tax plus NICS rate that applies to ordinary earnings. Now, maybe someone would think that the right answer is that we should have an intermediate rate of tax that applies to some of these other things. But at least you would be forced to make that decision consciously, rather than at the moment it ends up being an accidental byproduct of this government decides to cut income tax, this government decides to put up national insurance. They're doing it for other reasons, typically, frankly, as Helen was saying, to take advantage of the fact that people don't understand these things properly and think of them as having differences that aren't really there. But they have some of these real differences that end up as an accidental byproduct, and those are things that should be debated and decided on explicitly.
There's a couple of examples you often hear floating around. Like, is it fair that the landlord pays lower tax on their rental income than the tenant pays on the job they have to pay the rental income? That's one example. Another one is if you have a very high earning lawyer who's not employed, who is getting their income in some other form, they might pay a lower rate of tax than the client who they're instructed to represent. And is that fair? Things like that. So those are sorts of the difference. Getting back to almost the horizontal equity point earlier on, that we can debate whether those people are similar, but that's what people have in mind, right?
Yeah, I think that's right. And I think the answer to that question is not as simple as you might think, and we'll come on to discuss this
Very exciting.
in the next episode. Broadly speaking, and say, well, yes, if you are just doing, as it were, ordinary work like anyone else, then the fact that you're doing it through a slightly different legal structure should not mean that you're taxed differently. If you're actually doing something different, whereby you're investing capital in something, for example, then there is a case for doing something different there. My point here is not to adjudicate on whether the tax rates should be different, whether they should be higher or lower, but just to say that at the very least, they should be transparent, and we should be having a debate as to how high should the tax rate on different forms of income be, rather than have it as a hidden byproduct of the fact that we have this income tax rate and that national insurance rate, and they apply to slightly different definitions of income.
Which probably draws to a close soon, because we've been going for quite a long time on income taxes. So we started at the top by talking about how governments are ultimately trying to raise revenue and fulfil their redistributive desires, whatever those are. What we're talking about with the design of the tax system is how the government can do that in better ways, how it can do it without distorting people's behaviours by more than it needs to. So, for example, not distorting its work incentives by more than it needs to. How it can do so in ways that are horizontally fair, so taking similar people and treating them similarly, how it can do it in ways that are transparent and not too complex. We talked about income tax and national insurance, the biggest two taxes we have. The schedules are more complex than they need to be. We could make some improvements there. And we've talked a lot about how it's a bit odd actually that we have a second tax that walks like an income tax, quacks like an income tax to a large degree, but isn't in fact an income tax. And there would be a strong case, I think, for actually merging those two taxes together, predominantly actually for this point about transparency. People don't understand national insurance. I think if it were a merged tax, they'd have better understanding of that tax and how it functions. But for now, let me say thank you to Ben and Stuart. Do come back next time, because capital taxes are even more interesting than income taxes. But for now, let me say thank you to all of you listening. If you enjoyed this episode, please do like it and share it with your friends. And if you'd like to become a member, you can do so for as little as £10 a month. You can just check the link in the episode description. Thank you.